Hello, accounting and business finance students. I want to talk to refresh your memory about, accounting equation. As you all know, we always say that, in the balance sheet, you always see assets, liabilities, and owner's equity and we call it the accounting equation. And we know that when we say equation means equal, and you see this equal sign here. One question you might have is that why the accounting equation is always stays equal, and that's very simple. That means the assets of every company, the assets are equal to liabilities and the owner's equity. Why it is so? Let me give you a simple example and then we go from there. As the chief financial officer of a company, you are supposed to know about accounting because that's a major part of the job of the chief financial officer of a company. Now, I want to give a simple example. This simple example, think about a cab driver, for example, wants to start his or her own business. For simplicity, I use the term her. Just imagine that a lady decided to be a cab driver and wants to, start her own business. This person goes and buys a cab for a price of $10,000. Therefore, as soon as she buys the car, the cab, it is $10,000. The assets of her company is 10,000. That's, if she decides, to sell it, they buy it from her for $10,000. However, this person didn't have money to buy it in cash. She goes to a bank, let's say Summit Bank or Bank of America, borrows $9,000. Therefore, and also she puts $1,000 of her own money. Therefore, when you look at here, you have $10,000 here. That is equal to $9,000 of her own bank plus $1,000 that is, her own money. As you see, this equation is balanced. Let me make it larger that you can see. And as you see, this $1,000 is the equity that she has. I marked it in yellow. The liabilities that she has is, 9,000, and the assets of the company, which I use green, is therefore you now understand why this equation is always, is always supposed to be equal. Let me tell you something. If next month she goes and pays, let's say $1,000 of her, loan to the Bank of America, therefore, in this case, this number won't be 9,000. In that case, it will be 8,000. However, when it becomes 8,000, the good thing is that this 1,000 becomes 2,000 because now she owns 2,000 worth of that cab, and therefore 2,000, this becomes $2,000. And then what she owes is $8,000, 2,000 and 8,000 makes it 10,000. Again, it is equal. Therefore, this one went down by 1,000 when she paid 1 year, 1 month of, payment. This went up by 1,000. Therefore, the equation remained the same. It didn't change. It remained equal. Now imagine that if this cab driver suddenly, let's hope not, she goes and hits a tree. What she hits the tree, the damage to the car is $1,000. What happens is that the value of this 10,000 drops to 9,000, but also she loses $1,000 of her own equity because now if she was to sell it, out of that they buy the car for 9,000. She owes the bank maybe 8,000, and only she gets $1,000. Do you see? It always remains balanced because if one time this goes up, suppose this can go down by 1,000, that stays down. That stays equal. If suddenly this one goes down by 1,000 because of the accident, this goes down by 1,000 by the accident. Therefore, everything drops down by 1,000, but our equation still stays the same. That's why the accounting equation always stays the same, because when something is impacted in here, for example, it will impact this part as well. Or if it impacts this side, it will impact this side as well. Or if it makes this one to go up, it makes this one to go down on this side. That's why it's always staying, balanced. Now we come here, and now I am using an expanded version of, the business of this cab driver. The assets of her company, which we said is, for example, at this time, at the beginning when she bought the car, were 10,000. Equal these assets were equal to what? Liabilities that she had, $9,000 to the bank and $1,000 of her own money on the first day. That's why, think about that. That means that's the stocks that she had. Maybe it was a sole proprietorship. Her own company didn't have stocks, for example. But you may think about that common stock means that what is she had? That's the stocks that she has, stocks of her company. That was 1,000. But on the first day, she didn't pay herself anything. She didn't take any money out. Therefore, these are nothing. She didn't have any revenues on the first day. But as time goes by, then these things will come into place, and then they make the assets to be equal to this. Now, we know what the assets of her company is. That's her car. Imagine after a few months, she starts, accumulation, using the cab. Now what will happen to these assets? They all, these are all assets. That's why I make them in green. Therefore, after, suppose 1 year or 6 months, well, let's say after 1 year, she will have the assets of her company grow. What will happen? Imagine that she still has her car, but her car after 1 year, it doesn't work, it's not $1,000, $10,000 car, because she has used it for 1 year. Therefore, in that case, let's think about after 1 year. You see here is written property, plant, and equipment. Think about that property, plant, and equipment, and imagine maybe I should have put, suppose, and car, for example, because she has a car, a cab is a car. In this case, this component will become $9,000 because she, of course, the true value, although is 10,000, but do you see this one? Accumulated depreciation, $1,000 drops from the value of that 10,000. When you put $10,000 here, and when you deduct 1,000 for depreciation, therefore, what will happen is that the value from here to here becomes $9,000. Now, this cab driver has worked hard, has cash in the bank. Imagine she has as much as, $200 in the bank. And also imagine she has given right to one of her friends. She has not paid her any money. Therefore, that is accounts receivable for her. Therefore, that's an asset for her company, because if one day she decides to sell the entire company, what she will do, imagine this cash is in the account of her business. She doesn't touch that. She can sell that as a one package to another buyer. That buyer will take over this cash, which is $200, will take over this account receivable. Imagine that her friend owes $100 because she gave a, right. Then she has an inventory for her cab. What is that inventory? Think about that maybe she bought a good stereo, or she bought a kind of, let's say, extra tires for her car. And then also she paid her insurance for the car for 1 year, 2 years, for example. If it is after 1 year, that means she has used up 1 year of the insurance, but she still has paid 1 year of insurance. Therefore, that's again an asset that increases the value of the car, of the cab she decides to sell. And we did talk about this one. We understood that the entire this one from here to here is 9,000 because the value of the car, we put $10,000 here, and each year her car depreciates with 1,000. Therefore, from here to here, the value is 9,000. And imagine this cab driver was a smart investor. She also invested something, of the money of she made, in some kinds of investment and intangible assets. Of course, she doesn't have an intangible. What are the intangible assets? Is that these are some assets that you do not, if she goes, she sells it, she doesn't have. But let's say a company like McDonald's, for example. Let's hope not if it goes, bankrupt. They come and sell all the equipments, but that logo of McDonald's might have a value. Do you see? It's just a logo. It's not an equipment, but that logo itself, or maybe it can sell the domain name of McDonald's.com to another company. That is not a tangible asset, McDonald's.com, but that still has a value to it. Therefore, they can sell that. They go to a company and says, okay, they go to Burger King or something and say, we have a domain called, we have gone bankrupt. You come and buy this domain name from us. Anyone types McDonald's.com, it falls into your website. Therefore, that's a tangible asset. Therefore, for this cab driver, after 1 year, this is what she has. Imagine if we add all of this together, it will become $12,000. That means from here, this side of the equation is $12,000. And on this side, most likely this is $8,000 because she, paid $1,000. Then her owner's equity becomes $3,000. Therefore, here on this side, the total is $12,000. And on this side, it is $12,000. Accounting equation will becomes equal. If one day she decides to sell the business, the entire business, someone buys it, has to buy $12,000 from her. Therefore, this is called the accounting equation. And let's not forget that sometimes accounting equation is different than the concept of finance. Why the concept of finance can be different is, I will explain it, later, but, for now, you have a general idea that you understood the part of the part of assets of her company. But she does have some liabilities as well. Let's see what liabilities. Do you see they are in blue? And let's see what the liabilities are. And the liabilities she can have is that she has accounts payable, which means imagine that she has got a credit card on their what is that called, under the for the company. Therefore, that means that she has to pay it at the end of the month. She has to pay maybe $50. She pays it, every month pays it off. That's accounting payable, short term. But she has loans payable. Do you remember she borrowed $10,000, then she paid, she borrowed $9,000, then $8,000 she owes. Therefore, on that $8,000, she every month she makes a payment. Salaries payable. Imagine she has hired someone when she is off, drives. On earned revenue, that is a liability. These are, liability is something that if you do not take care of it, they can take you to the court, which means if she doesn't take her credit card, she might end up in the court. She doesn't pay the loan, she might end up in the court. If she doesn't pay the salary of the person who helped her, when she was sick, took care of the customers. Unearned revenues. What are these? These is that imagine she has a friend. The friend gives her upfront $50 and says, could you take me to the hospital next week? Now imagine if she wants to sell her business, the new buyer is responsible to take care. These revenues, therefore, it is a revenue, but she hasn't earned it yet. That means it will happen in the future. Interest payable, she has to pay interest. Taxes payable. She has to pay taxes to federal government. Bonds payable. Imagine company. Of course, she doesn't have bond. Companies have, bond. Rent payable. Imagine that she doesn't in DC. You don't want to park your cab in the street. You would rather to have a garage. She can buy her own small garage. Therefore, or rent. She has to pay. Utilities payable. Businesses have utilities payable. Maybe she has, or that garage has some, electricity or something. Notes payable, that is again some types of payable. Wages payable, and these are the liabilities. And we had to add them to the owner's equity. What about our owner's equity? Do you remember we said that, that she put 1,000 of her own money, of course, in public company and sometimes private companies. Also, we issue stocks that we said in her company because it is sole proprietorship. It is a common stock. And it's just a regular ownership of the car. And retained earnings is when she makes money and she doesn't waste it at all. She just keeps it in the company. Therefore, that adds value to what she can. If she sells it, this will help her to, get more money when she sells the car. This is when she sells the car to someone. Of course, these liabilities don't go into her pocket. When she goes next year, pays the car for, we remember we said if she sells the car for $12,000 next year, she owns, for example, $4,000, will remain in, that's what she, will have in her pocket. She can sell her, cab. And then we will talk about these as well. And therefore, let me mention this one. What does this one do in here? This one in accounting as income statement. Income statement is when she has income. What can happen to that income? The income, of course, she has revenues because every day that she gives a car ride to someone, to people from morning till night, there are revenues come. Imagine that in one day she gives gets $200 in cash. Therefore, the revenues are $200. However, she has some expenses. She uses $50 of those $200 to put gas in the car. Do you see that? Therefore, that's why we say revenues minus expenses. This is equivalent to $150. Do you see that? Because $200 minus expenses. That will, because $150 is added to the company, to her company. Do you see that is similar to this part of yellow? Isn't it? Because that is not a liability. That will help her with this yellow one. That $150 increases her ownership. Owner equity appears in yellow. The reason we separated it in here and didn't put right into yellow color, because this component comes from another statement that it as income statement. But these are always, you always see this in the balance sheet that always is balanced. I put something for you here, although is not necessarily the subject of today's discussion, but in your accounting class, you all learned that anytime these guys on this side of the equation, if they go up, they are debit. If anything on this side of the equation go up, what are they? They are credit. Therefore, anytime it increases, that means if her accounts receivable increases, that will be a debit. Which means, how does her accounts receivable increases? Is that increase? She gives more right to her friend, but her friend hasn't paid her yet. Therefore, that is what she's expecting to return, to get paid. Because it has gone up, she gives 2 extra rights. Therefore, that accounting payable, receivable has gone up. Therefore, that we consider that as debit. Anytime these things go up, but anytime goes down, instead of being debit, as you all know, because if it goes up, it is debit. If it goes down, it is credit. How does it go down? That's when she gives the right to her friend. When she gives a ride to her friend, that means her accounting receivable. Imagine that $100 ride she gave you. That was was supposed to be given. She had got she receives the money, and this will go down, and therefore that is getting credit. Now, one question you have is that why did we put this accumulated depreciation? This is very important for many of you also who take accounting or intermediate accounting and other concepts, or work for organizations, and you have to create this accounting equation. Your question would be, why did I put this one in pink color and I didn't put it in green? If you look at here, everything in here has a plus sign, but this particular thing, as you see, has a minus sign. Therefore, if it has a minus sign, therefore it has to be, marked that is a kind of different thing. Why did we do that? Why did the accountants brought and put this accumulated depreciation in here? Because it is a negative, that means this one in here was supposed to be in the blue part, because if it was in the blue part, it could have a plus sign, but the accountants intentionally moved it from the blue parts and brought it and put it in, added in the green area. And why did they do that? They had a good reason to do. Because, do you see, this accumulated depreciation is against your car. That means that because every year it eats up your car, it reduces the price of your car. Therefore, the accountants make something very smart. Let me put it in parentheses that you understand, which means that this equipment every year is being damaged by this accumulated depreciation. By doing so at any point of time, you as an accountant see that this equipment always stays as 10,000 because that's what you originally paid, but this accumulated depreciation every year $1,000 will be added to that. Therefore, after 3 years, you will have $10,000 here, but at the same time, you will have $3,000 here, which means by one look, you will know that the total here would be 7,000. Therefore, anything that is damaging your equipment, which is this accumulated depreciation, will be shown with a negative sign, usually next to your equipment. In the buildings as well, you have, depreciation. And that depreciation, right? Do you see here says, property? If I wanted to show you in color, I would have put that depreciation of property, and I would have put it in a pink color, because that makes your job easy. Because by one look, after 6 years, you will see $10,000 here, and you will see $4,000 accumulated depreciation. You quickly know that this component is supposed to be 6,000, and it shows how valuable your cab is. Therefore, anytime something eats up your assets or damages this one, it will be shown as a negative. Let me show you another thing that damages something. I want you to look at these revenues, and do you see that revenues have tendencies to increase your ownership? When she makes $2,100 of $200 giving ride, that is going to help her and make the value of what she has by $200 more. But what will happen? Something damages that $200. What is that? When she goes and put, that means it reduces the revenues by $50. Therefore, that's why, again, the accountants have done something very smart. These expenses were supposed to be here in the green one and have a plus sign. but the accountants intentionally brought it here to put it next to revenues, which is a very good idea because it shows when she made $200, that is what she made, but this damage to the $200 brought it down. Therefore, they put these again together. And now, as you all know, we said that anytime these green ones go up, that is what? Debit. However, this guy, because originally belonged to this side of the equation and the accountants intentionally brought it here, therefore, if this guy goes up, this guy is not a debit because it belonged to this side of the equation, which means each time it goes up, that is a credit because it belonged to this side of the equation. Similarly, this expense, anything on this side that goes up with is what? Credit. However, the expense originally belonged to here and had a plus sign, but the accountants from here moved it here. Because they moved it here, it got a negative sign. And therefore, anytime this goes up, anything in blue goes up, that is a credit. Even the yellow goes up, that is credit. Do you see that? Only this pink one, if it goes up, because it belongs to here with a plus sign, then that is a debit. I want you to understand this accounting equation because that will help you significantly in terms of, understanding many other facts about, the companies. And anytime the green ones go up, they are asset. Anytime the blue ones and yellow ones, go up, that is a credit. And then you understood now that why these expenses were brought and put it here. That was a smart thing the accountant did. That way, at the end of the night, you know how much you made, how much revenues came, and how much next day she drives $300, $300, makes $300, gives, right? But she spends, let's say, $150 for gas, or $100 for gas. We know that this becomes $200 the total. That means her ownership goes up by $200. Therefore, by having this, anytime she decides to sell the company, the new buyer wants to look at the accountant of a new buyer who wants to buy her company, likes to know about all of this, how much she owes, how much her car worth. Quickly, if they want to know how much the car worth, the new buyer will come and look at right in here, says, okay, that was $10,000 car, you have driven it for 5 years, 10 minus 5, the value of the car now is $5,000. Likes to know how much she has loans, she has how much she owes to other people. That is the concept of accounting equation. Those of you, as I said, are taking accounting 101. That helps you. Those of you who are taking computerized accounting, this is something will help you, and it is a big component of finance when you want to be the chief financial officer of the company. This is my first lecture. I am going to send you more lecture with more videos. I want you to understand because we are going to use this accounting equation to understand other subjects and post something on the discussion board.